lot of it has to do with liquidity. So historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, generally when liquidity is rising, that's pretty good for Bitcoin. And when liquidity is falling, Bitcoin's usually either going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then, if not for the whole FTX debacle. And so that kind of delayed the rally, but, with that somewhat resolved, and now, kind of moving forward, I think, Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so, basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place.
Well, it's really interesting because before the price started to go back up, you wrote in your last newsletter that the last time the 2-year Treasury yield dropped below the Fed funds rate near the top of interest rate hiking cycle, it marked the end of the cyclical bottom for Bitcoin. So is that perhaps what we're seeing?
Yeah, so I kind of pointed that out as like something that no one should trade on that specific thing, but it's more like an observation. And that part of the underlying causation, that correlation, is that generally that's the 2-year, the market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. And so right now, I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But, I think when you look in the second half of this year, there's still some liquidity concerns. Mm-hmm. And so kind of like how in the prior Bitcoin bear market, you had the major bottom in, say, late 2018 into 2019. That was the big bottom. But then you kind of had like a later liquidity shock through March 2020, where you went down and went up much faster. It was again, another liquidity issue. I wouldn't be surprised if something like that, like a sharp retest, but it's too early to say, because it partially depends on what humans do, what Jerome Powell does, what different policymakers do. And of course, that's always impossible to predict.
So do you think right now that Bitcoin's more affected by the macro environment as opposed to, let's say, the crypto dominoes that were falling, even though we just had, I believe, right before we started this conversation, headlines that said DCG is preparing, or Genesis preparing potentially for bankruptcy?
So I think there's still big things like that can move the crypto specific industry. But overall, like historically, Bitcoin has been very correlated to macro factors, and specifically liquidity. And I've looked at it over the past couple of years, because a lot of people, they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at, say, Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding, growth is accelerating. When that's going down, growth is decelerating. If it goes below 50, it's potentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs. Like, it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs, and Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry-specific blow-up, like we saw with FTX, and like you might see with some of these others, that can temporarily override the macro factors, because it doesn't matter if liquidity is good if there's some massive forced selling whale out there.
How would you describe liquidity right now in the Treasury markets? Let's turn a little bit more to the macro environment, because one thing that I guess I'm just constantly surprised by is the fact that we aren't officially in a recession yet. We had 2 consecutive quarters of negative GDP growth, but then we had positive. And I know that the service sector is still relatively strong. There's low unemployment, but it certainly feels like we're in the middle of this very significant economic slowdown. So how are we not in a recession?
So most of the indicators point that we are like early stage recession or late stage expansion. And so a lot of the leading indicators, like, conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation adjusted retail sales are rolling over. And the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those two negative quarters weren't kind of a full recession, is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So, for example, if you look at overtime hours, those are on the downtrend. If you look at temporary help, that generally is a more volatile leading part of the overall labor force, because imagine if you're a small business and you're running into tight times, you might reduce your temporary help service before you would let go permanent employees. And so those are actually down year over year. And so basically there are multiple small signs that the labor market's cracking, which combined with all the other indicators, inverted yield curve, contracting PMI, it kind of points towards likely recession. But I think we're still in kind of either the pre-recession stage, or they always declare a recession months after it happens. So it's possible that this is like already part of the recession. But if it is, we I think still really early stages.
And how are valuations looking? Because I know that there was a concern about equities earning multiples last year, but now it's more so corporate earnings for this year, right?
Yeah, so 2022 was a story of earnings multiple contraction. So it's not like earnings went down yet. Basically, you had some non-energy earnings fall a little bit. That was offset by energy earnings. So overall, S&P 500 earnings are currently fine. But you had because you had a sharp rise in interest rates, you had a sharp reduction in valuations. And one simple way to think about it is if usually the 10-year treasury is like the benchmark that you compare equities against, right? If you can get a 6% yield on a 10-year treasury, you might look at equities and say, I'm only going to invest if I can get 5% better than that, right? So I want 11% expected returns, therefore I need to buy them pretty cheap if I want to comfortably beat the treasury. On the other hand, if the treasury is yielding 1% and I still want a 5% equity premium, I might buy equities even though I only anticipate that they're going to give me a 6% return, and therefore I'm willing to pay more like a higher earnings multiple, lower dividend yields, things like that. And so as you've seen a sharp rise from your zero yields all the way up to well over 4% at one point, that put a lot of downward pressure on equity valuations, especially growth-oriented equities. And I think that part of the story is now largely behind us. And the question for 2023 is, are corporate earnings themselves going to be very weak? And I think that, I don't think they're going to collapse, but I do think that they're going to be weak.
Well, and one thing that you also mentioned that I thought was really insightful is the fact that even if they don't necessarily keep hiking rates, let's say they want to hold them in one position, that essentially does get tighter in and of itself, because debt comes mature, and then all of a sudden you have to refinance at these higher rates. And we're already seeing so many bankruptcies. We had Bed Bath & Beyond today. I think you tweeted Party City. So is that also going to impact the greater picture?
Over time, yeah. So a lot of people have been surprised at how much the Fed's been able to tighten. Somewhat me as well. Basically, if you would have asked me a year ago, would I think the Fed would get this high this quickly, I would say no, probably not. But if you do it fast enough, you can get away with it for periods of time. I mean, if the Fed just came out and said, interest rates are 7% for one day tomorrow, it's not like all these companies go bankrupt. It's about both the height of that interest, and then it's also about the time spent at that interest level. And that's because a lot of debt is fixed rate. So homeowners have 30-year mortgages, corporations have 5, 10, longer bonds. Government also has a range of maturities averaging 5 or 6 years, but it ranges from almost instant to 30 years. And so when they sharply raise interest rates, that only starts affecting the marginal debt that comes due and then gets refinanced. So if you just leave that interest rate where it is quarter after quarter, that starts to impact more and more types of debt, even though you're no longer raising the interest rate. And of course, another factor to consider is not just the nominal rate, but also positive rates, right? So if you look at some emerging markets like Turkey, I mean, if you have, I don't have the numbers in front of me, let's say you had 80% inflation and you had 40% interest rates, is that tight? Of course not, right? So that's very loose. So a less extreme example is that if you have, 7% inflation and you have 5% interest rates, are you tight or are you loose? And the answer is that you're actually pretty loose. And so real yields are still negative in many ways of looking at it. Now the challenge there is that there's multiple ways to measure real yields, because CPI is apparently a lagging indicator. It's backward looking, rates are forward looking, and so it's hard to do that apples to apples comparison. So there's things like break evens, which are basically ways to measure the market's assessment of forward inflation. But then the problem there is that it's usually very inaccurate, and they were not expecting inflation that we got in 2021, 2022. And so right now, overall, we're still not that tight relative to inflation, although I think we're getting tighter as inflation comes down and as we stay at these tighter levels for longer.
Right. And did you see that update that came out that apparently the CPI calculation is going to be different starting in February as opposed to looking at 2 years? It's going to be one. So a lot of people think that all of a sudden it's going to, show us a lower number that's essentially not necessarily manipulated, but you're changing the calculation on us.
So I think I've seen a number of people kind of report on that, I think somewhat incorrectly. There's a nuance there. So basically, inflation is always measured year over year. But the question is, what basket are you measuring inflation by, right? And that's always been a long-term controversy with CPI, which is essentially that, you buy a basket of goods and I buy a basket of goods and services, and our baskets are not identical. You might spend more in one category, I might spend more in another category. And so if we calculate our personal inflation rates, they would not be identical. That's like Michael Saylor's quote that inflation's a vector, not a scalar. It's like the mathematical way of putting it. And what the CPI tends to do is say, okay, what is the average American's basket of goods and services? If we do all this research and say, what is the average basket? And of course, the basket changes. If you looked at a basket in the 1970s, it's different than the basket today.
Right.
They didn't have laptops that we're talking on. And so basically they regularly update the basket that they use as representing the what they calculate CPI by. And they used to use a longer rolling period to determine what they're actually how they're going to weight that basket. And what this announcement says is that they're only going to look past the last year, which means that the basket changes more rapidly. And that can actually sometimes result in lower measures of inflation, or it can result in higher measures of inflation. Mm-hmm. So for example, during the COVID shock, the lockdowns, people stopped buying services. They stopped going to restaurants, they stopped flying, they start buying electronics, they start remodeling their home more, consumer durables. You had this mismatch. And then, everybody comes out of the lockdown, they all start flying, they all start going to restaurants, and then they stop buying consumer durables, right? So services, some people